over the next 10 years, if they are growing their capital base, not just by issuing more common stock, but also by proportionately issuing far more preferreds, and that there's lots of demand for these, and that the interest that they're paying on the preferreds goes down, and with the Federal Reserve signaling that they could be lowering interest rates, that's where we enter into a scenario where strategy could go from having 4% of the Bitcoin out there to 8% of the Bitcoin, which is an astronomical number. I think that's where we really get into the moon math. Welcome to the Bitcoin for Corporations show. My name is Pierre Rochard. I'm your host today. And today we're doing a special episode with our producer, Spencer Nichols. Spencer, how are you?
Hi, Pierre. Doing great as always. How are you doing?
Doing very well. Yesterday we had the Q2 earnings call for MicroStrategy, or now Strategy, which covered a lot of very interesting material at the intersection of Bitcoin and corporate adoption.
So, Strategy's earnings call yesterday, I think, was relatively monumental, and I don't think that was really reflected by Strategy stock price or the Bitcoin price. Not surprisingly, I suppose, but really what Strategy was doing was laying out a case for what the Bitcoin banking model looks like in the future. I think the word credit was thrown out about 100 times. And in addition, for this earnings call, I thought it was nice that there was this analyst Q&A portion that included Bitcoin analysts. I think a voice that we have not heard much in the earnings call space within TradFi. So that I think added some great color too, and was a big step in educating TradFi just about Bitcoin. I think there's a lot of folks that are now involved in the strategy trade and strike, stride, strife, and stretch that really are not Bitcoiners per se, but are really coming to understand Bitcoin through the words of Michael Saylor, which I think it gives me a bit of a kick just knowing that that's going on out there.
Yeah, and also just doing it via YouTube Live and on X, where they really are changing the way that companies interact with their investors. Before it was, you do like a webinar on some strange website. So I think that it's a huge improvement in terms of communicating what the vision is for a company.
Yeah, absolutely. And I think before the earnings call went live, Strategy released their earnings report. And one of the biggest things that stood out was Strategy's earnings per share. And this had kind of been something that had been long foretold. People were excited to see number go up when it comes to that, when Strategy is able to account for the value of their Bitcoin holdings under FASB's guidance. And Pierre, maybe you could just explain a little bit more for the audience what that means. And if do you think this is a material change to how Strategy is valued, or is it more just a clerical function?
Yeah, so historically, what would happen is that if the Bitcoin price went down, then they had to write down the value of the Bitcoin in their financial statements. And so they would recognize a loss. But if the price went up, they actually could not write up the value of the Bitcoin. And so there would be no flow through into the income statement. The good analysts, they would go in and manually adjust that so that they are writing up the value of the Bitcoin in their valuation models. But the reality is that there's a lot of systems that are basically automated, right? Where that kind of manual fix doesn't happen. And so it was really good that FASB came out and recognized that, look, if you have an asset like Bitcoin that's traded 24/7, that is very liquid, it does make sense to mark to market, to take a look at, okay, what's the value of it on December 31st? And let's recognize that as an unrealized gain on the financial statements. And so that way it flows through into the earnings per share so that you can actually show to the shareholders, here's the economic value going on. And it's not just arguably, political or arbitrary thing of, hey, like, we don't like Bitcoin, so we're not going to allow you to recognize unrealized gains on Bitcoin. So I think that's a huge improvement just on first principles of reflecting reality. Does it actually change the economics for the company? No, I don't think it does. I think it just, it will help information flow. But it's also, I think, important from a media perspective and from a mainstream, Wall Street Journal perspective, that then they can go out and say, here's our earnings per share and compare it to other companies. And so a big important part of financial accounting is principle of comparability. So you want to be able to compare Strategy's earnings to Microsoft, to Nvidia, et cetera. If you start having to do manual adjustments everywhere, then you lose that comparability. So I think it's overall it's good. As you point out, it doesn't mean the stock price immediately goes up because there were plenty of analysts who were already factoring that in. I also think, though, that in terms of future corporate adoption by others, it's really important because the board of directors, they are sensitive to the accounting treatment of different asset strategies. And so if you can't recognize any gains, then the board of directors might be more cautious and risk averse of saying, well, look, there's basically only downside here because we'll only be able to recognize losses. Going forward now, boards of directors kind of lose that excuse to say no in terms of adopting Bitcoin as a balance sheet asset.
Yeah, and before we get into more of the specifics of the earnings call, do you have any more thoughts just on the importance of investor relations in the Bitcoin Treasury space? I think we've seen a number of firms out there that go out and hire a director of Bitcoin strategy, for instance, and they'll see that reflected in the stock price, or at least the correlation is extremely tight. And so, I think to me, this begs the question of what is the value of having a strong investor relations foothold as a Bitcoin Treasury company? And how might that differ from like just TradFi generally? Because there really seems to be an emphasis on the Bitcoin podcasters bull market that is underway right now.
Yeah, so I think that there's two dimensions to it. There's the internal dimension, which is that a Bitcoin strategist at a company, and I've been one myself in the sense that I worked at Kraken as a Bitcoin strategist and at Riot as well. So internally, you want to be driving Bitcoin education forward at all levels. So whether it's the end customer or entry level employees who are doing their onboarding. And so you want to provide a Bitcoin 101 for them. And then management helping shape the strategic direction of their decision making. And then the executive team and at the board level so that they are understanding that, the risk is really in terms of being underexposed to Bitcoin. It's not about being overexposed to Bitcoin. So that's where I think that it's really important internally to have a Bitcoin champion who not only understands how Bitcoin works on a technical level so that they can push back on FUD, all right, which there's always a FUD cycle, or most recently quantum computing, but also that they understand it on an economic level so that they can say, hey, look, like, okay, we might be facing some volatility today, and it might feel like the world is ending because Bitcoin is down 5%. But let me speak from experience that this is actually an opportunity to accumulate more Bitcoin and that nothing is impaired about the underlying Bitcoin system. So there's that, and then internally as well. Of when you're thinking about what kind of products to develop, and in particular for capital markets, to be able to design those so that they do actually differentiate themselves from existing products in the sense that you want to be more resilient to volatility. So you don't want to create a capital structure where you're over leveraged and you have to liquidate the company. And two, also acknowledging that Bitcoin is going to have superior returns over time. And so when you're designing what the dividend policy would be, for example, for a perpetual preferred, you can probably go for a higher percent than you could for financing other assets, just because historically Bitcoin has that very high compounded annual growth rate. So that's on the internal. On the external, then you want to be able to communicate one to institutional investors about Bitcoin, because the whole company's approach to their corporate strategy is Bitcoin focused. And so there's going to be lots of questions from institutional investors about why the company is bullish on Bitcoin. What do they see in it? And how does it fit into, okay, well, you might have some other operations. You might have some new initiatives around that. So you want to tie that to where you think Bitcoin's going to go over the next years and decades. Two is on the retail level that you want to be able to explain to the retail investing public what is differentiating this company from other Bitcoin strategies. And so I think that when we look at the success of MicroStrategy and more recently of MetaPlanet, is that they've been able to find that Venn diagram of people who are bullish on Bitcoin and also interested in investing in equities. And so that might seem difficult at first, right? Because there's so many Bitcoiners who their interest in Bitcoin is that they don't want to read a 10K. They're not interested in financial accounting. They don't want to trust a management team. And that's why they're interested in Bitcoin. And I'd say that that's a great, percentage of the Bitcoiners out there. There's also lots of Bitcoiners who they've got a big stack of Bitcoin already. They're happy with it. Now they're looking at, okay, what are other opportunities out there that are aligned with that long-term Bitcoin vision? And that's where, education and being able to explain what the company's purpose is could potentially attract capital flows from those retail investors. So I think that's kind of the two main prongs of why it's important for companies to have Bitcoin champions on their team to be able to drive that internal education as well as the external education.
Yeah, that makes a lot of sense. And speaking of capital flowing perhaps from Bitcoin back into these equities or any of their offerings, I think Adam Back comes to mind with his SPAC with Cantor. I think someone who has a lot of Bitcoin in cold storage, or I guess just outside of a custodianship, and trying to bring that back into the capital markets and see where they can put that to work. But yeah, appreciate you sharing that perspective. So I think. Would love to just jump into the earnings call. I think my really biggest takeaway was Saylor's explanation of stretch, stride, strike, and strife, and really unpacking who these different investors are that these instruments should appeal to, and really like what his macro strategy is. And before we jumped onto the call here, you and I were discussing like it really the scale of Saylor's ambition, I think, was, if not grand, ambitious. I think just to jump in there, I want to play this clip from their earnings call where Saylor discusses a little bit of this strategy.
What we're doing here is we're building out a yield curve for BTC credit. And so what you can see here is that stretch looks like a 1 month instrument. It's way pegged to the left. It's like a 1 month T-bill. Stride it has a Macaulay duration of about 8 to 9, strife more like almost 11, and stride getting closer to 14. Now, those instruments like strife and stride and strike, they're perpetual. So as the credit of the company improves, as Bitcoin increases in price, as the BTC ratings go up, it's not unlikely that those durations will keep stretching, right? That at some point, if someone thinks that strife should be yielding 5%, the duration will stretch to 20 years. And so they're going to stretch out on the duration curve, and that's a function of credit spreads and SOFR and Bitcoin. Stretch, on the other hand, will always be pegged at 1 month. And then what's the opportunity? The opportunity is between 1 year and 10 years. So we're in a position to issue a perpetual preferred instrument that's a 1 year credit instrument, or 3 year, or 5 year, or 7 year, or 10 year. And it would be based on the stretch rate, and it would be precisely exactly 7 years, rolling forward 1 month, just clicking forward. So it would always be 7 years out, or it would always be 36 months out. And what's the opportunity for that? Well, there's $30 trillion of medium duration corporate credit, right? Out there. So $30 trillion of capital, that's the opportunity. And that means we're in a position to build a perpetual yield curve, 1 month, 1 year, 3 years, 5 years, 7 years, 10 years, and then perpetual going out 15 to 20 years or longer. And what you'll also notice from this chart is that at all ports on this duration curve, we've got higher yield, right? So we're offering higher yield on the short end of the curve, we're offering higher yield in the middle, and we're offering higher yield on the end. That means our credit is stronger, right? Longer duration, higher yield.
So I think we can stop there for now and just discuss a little bit. So what Saylor is discussing is basically he has these perpetual preferred stock offerings that he's given to the market, and these have variable durations and variable yields on them. And to me, it looks like what he's trying to do is just reconstruct what is commonly known as the yield curve for U.S. Treasuries, but doing so with kind of Bitcoin as the standard. And so there are just so many parallels to central banking that come to mind here when I'm hearing Saylor discuss this. But Pierre, would love to just get your reaction and to hear, what comes to mind when you hear Saylor discuss what he's done thus far. And then also there's that gap of 1 to 8 years or so that he mentions of the duration that they've not yet issued this perpetual preferred program into. So just kind of want to help have you unpack that a little bit for the audience.
Yeah, absolutely. So I think there's a lot of commonality with central banking and honestly with just normal commercial banking as well. And what's striking to me is the differences as well. So, for example, when they issue a perpetual preferred, let's say that the investor is giving $100 to Sailor, and it's perpetual. So technically, he doesn't owe that $100 of principal back ever. And the company instead, they're going to pay a yield, right? So they're going to pay some percentage as a dividend. If you look at how the US government finances itself, they actually have to constantly refinance the national debt. So I think the national debt's $34 trillion today. Um, they have to go out and they have to repay that principal and reborrow it, a lot of it within 1 year. So it's a very kind of short-term borrowing, whereas Sailor here is taking a very more risk-averse approach because the collateral, the Bitcoin, is has that risk of having a drawdown, right? So he doesn't want to be in a situation where he has to pay back the principal, and the Bitcoin price has gone down a lot. So the other interesting similarity is about adjusting the interest rate. So on Stretch, if the the trading value of Stretch goes up, right? So if it goes above $101, they're going to lower the interest rate so that all else equal, it would make it less attractive to investors, and so they would, sell the Stretch. And conversely, if it's trading below $99, then they're going to increase the interest rate on Stretch so that they're targeting $100 par value. And it starts to look a lot like a stable coin. Now, there's huge differences, right? Because it's not like it's tokenized. It's also um, backed by Bitcoin. It's not backed by U.S. Treasuries. But really, what we should compare it to is money market funds. So, money market funds, people use that to have kind of their rainy day, like 6 months of future expenses to set aside so that you're not in a difficult situation. And that's a multi-trillion-dollar market. And so they're able to go out and borrow for the long term, right? Because it's a perpetual preferred. But at the same time, from an individual perspective who is investing in Stretch, they're able to actually not worry about whether the principal's value will materially change, and so they'll be able to sell that $100 of Stretch in 6 months if they need it to go repair their car or whatever it is. So the design space, I think, that Sailor is highlighting here shows just how many different products they're going to be able to offer. And so if you use the metaphor of a central bank, right, they'll have a 1 month T-bill, they'll have 1 year, 5 year, 10 year, 30 year. But you could also use the metaphor of the iPhone, right, which I think Sailor used as well at a later point in the presentation, where you just have different kinds of products that are going to appeal to different customer segments. And it's all about designing those products so that they have the right set of trade-offs. And for Bitcoiners, I think that it's really interesting because even if you want to be 100% Bitcoin, you have to recognize that over the next 6 months, if Bitcoin goes down a lot in value, you might not have enough money to set aside to go on vacation or whatever short-term goals you had. And so we really have to look at Bitcoin as long-term savings technology. And then you need to think about, well, what plugs the gap between your long-term savings and today? Well, it's short-term investments, really, is what does that. And so today, that world of short-term investments has really had very low yields, and I think this is something that was highlighted on the call yesterday, which is that you might be at 4.5 or 5%, and Strategies offering now a product that is 9 to 10%.
Yeah, absolutely. And I think what is shocking to me, one is Strategy noted. I believe this has been I'm going to pull up the chart here. This is STRC, or Stretch, was the largest IPO in 2025. But if you look back at the previous chart, there is a huge gap on the chart where Saylor is spelling out the universe of yield bearing credit instruments. And from 1 to 10 years, it seems to be suggesting that they're going to be approaching this market with a lot of thought here. So, do you think that he'll just be focused on attacking this money market, or do you think that there is I guess maybe just put your finger in the air and take a wager, I suppose, but how might you think about capital markets in that way? Like what part uh of that yield curve do you think is the most appetizing for Bitcoin to start?
Yeah, so I really think that stretch is the one that is most
Hmm.
appetizing, because if you start getting into, let's say, 5 or 6 year duration, then really you start to wonder, okay, well, why not just hold Bitcoin, right? And so I think that the shorter term is more appealing and will have a lot more capital inflows. Could be wrong on that, but basically the thought here is that they're going to be issuing instruments where the person who is lending the money to strategy will be locking in an interest rate, right? So if they're lending to strategy for 4 years, they know that they're going to earn X percentage over those 4 years. Whereas with stretch, I think that the interesting dynamic will be how much do they do the ATM of, they just approved a $4.2 billion ATM that you pointed out. They have already issued $2.5 billion for stretch. How much do they tap the ATM versus lower the interest rate, right, to decrease demand? And so I think that, and to decrease their cost of capital, right? Because as they pointed out during the call, the more they have to pay in interest, right, that's kind of a challenge because that means they have to issue more MSTR shares and dilute the common stock. And so there's a balancing act that they have to do here. I think that was the other big announcement yesterday, was that they're going to provide guidance on at what points do they actually issue MSTR shares with regards to the MNAV. And this is something that has been debated a lot by the community, but also by the short sellers like Mr. Jim Chanos. So I think that this is a breakthrough moment for the Bitcoin Treasury companies to be really transparent about how they're going to manage the ATMs. Um, I think this is the first iteration, though. We'll probably see this kind of guidance get more and more nuanced, where instead of having specific MNAVs, they'll have something fuzzier like standard deviations from past 30 months of MNAV or something like that,
Hmm.
where they can actually try to avoid having bright line rules. But this is the way forward to give comfort to the investors that they're not going to get overly diluted. But I also, for those who have been really hard on a strategy for using the ATM in the past, I think that they should really reflect on that IPO of $2.5 billion, where that would have been impossible if the company had not been issuing so much MSTR to buy Bitcoin, right? The fact that they were able to develop this giant capital base of, you know, upwards of $50 billion worth of Bitcoin, that that's where really they're achieving a level of critical mass to where they can issue stretch and they can do a $2.5 billion IPO. If they had stayed small and said, okay, well, we're not going to issue a lot of common stock because we don't want to create a negative perception that drives down MNAV, well, then they would not have this opportunity to really create innovative fixed income products and to be able to do it at scale.
Yeah, I think that question of scale is one a lot of corporate Bitcoin treasuries are asking themselves: is what opportunities can we have by keeping a small scale and being relatively nimble, say trying to deploy this capital to acquire books that are trading under net asset value, for instance. But I think at the flip side of that, you have the scale and the economies of scale that strategy has, the liquidity that it can offer. that I think, to your point, is doing something that none of these other companies have attempted before in the space. So I think that differentiation and dividing line will be something to watch going forward for just the future of just like pure play corporate treasury companies.
Yeah, I agree. And if we go back to our metaphor with banks, I think another really interesting difference is that if you look at it, comparing to a commercial bank like a JP Morgan, for example, there is not a direct relationship between the investors and strategy in the sense that they are buying those securities at a brokerage account. So there's a direct relationship between the investor and Robinhood, for example, or Fidelity or Morgan Stanley. And then within that portal, within that platform, they go and acquire these products from strategy. Compare that to, for example, a JP Morgan, where they might have CDs or a savings account or even a money market fund where it's within their ecosystem. So I think that's actually really important for those who want to also offer these credit instruments to the public, where, if you're an up and coming treasury company, you want to be offering these perpetual preferreds, specifically like Stretch, for example, um, you could actually use marketing to be able to offer those to investors on a way that's really on the same footing as strategy because you're on the same platform, right? And so it's not like strategy gets any special favors from these platforms like Fidelity. The other challenging aspect of that, though, is that these platforms are gatekeepers. So, for example, Robinhood does not yet offer the perpetual preferreds, and so that's something where in terms of getting greater access for investors, the management team and the investor relations team, that's I think should be a major focus, is unlocking the access on platforms like Robinhood to get more retail investors to be able to use those products. Um, but from a competition lens, I think it's going to be really interesting to see. And Saylor pointed out that they have this challenge as well of driving the sales force, right? Where you have lots of bankers that have those personal relationships with individuals that are able to sell those products. Well, they're going to have to develop that sales force and the education to be able to place these products that are competing against incumbents. And so if you look at a lot of financial advisory companies, the financial advisors, they might actually get paid based on providing a specific product, selling a specific money market fund, where they wouldn't really get paid that fee by selling Stretch to their end retail user, even though it's a better
Mm.
product. And so I think that that's going to be interesting to see, how did Bitcoin treasury companies start to really develop a sales force for those products.
Yeah, and I guess what comes to mind for me too is I think since the approval of the Bitcoin ETFs and since they've been rolled out, is people keep talking about this new marketing department of Bitcoin that's coming from BlackRock and Fidelity and these other issuers, where they're essentially trying to pump their bags in some ways, and I think we're beginning to feel the cumulative effects of that. Um, but to your point, I think these individual firms do benefit from making that case themselves.
Yeah, and it takes one person at a time, really. And so, as scalable as it is that we have the internet and all this information is out there, it's really interesting how important just the personal meeting is of developing that trust, because really that's what these securities are. They're trust based, which is unusual for Bitcoiners. But I think that when we look at the overall adoption, for me, the fascinating part is the overlap in the marketing. So, for example, if you go look at the marketing materials for IBIT, for BlackRock's ETF product, they talk about how Bitcoin is permissionless, and that is what is driving the underlying value. So it's fascinating that even though they're selling a product that is a security wrapper where you do need permission to use it, they recognize that at the end of the day, the underlying asset is really being driven by this completely different philosophy.
Yeah, and I want to take a moment now, Pierre, to just kind of zoom out and really like put into context what strategy is doing here. Like on the one hand, there's a stock price and a ticker you can watch, but on the other hand, there's this whole universe of assets that's investable, and also I think that strategy is going to be competing against. So again, we look at strategy with their war chest of more than 600,000 Bitcoin. We look at Bitcoin sitting at about $115,000 a coin. In the event that strategy, continues to trade at a multiple to its net asset value, that it continues to engage in Bitcoin yield farming, I think is maybe way I describe it is, where does that place strategy like in these kind of future outcomes of, obviously Bitcoin could go to zero, and that would have a certain effect on their equity and their strategy. But like along these distributions, like where could strategy end up? And I think this comes back to the beginning of our conversation, is like, what is the end state of their model as kind of this Bitcoin bank? Maybe you could give us kind of just like the very high level, like kind of macro view of them as an entity.
Yeah, absolutely. So, if Bitcoin goes to zero, everything here goes to zero, right? The even the most secured one, Strife, at the top of the capital stack, that would go to zero. Although actually the convertible bonds above Strife would also go to zero. Interestingly, they mentioned that the convertible bonds are essentially on their way out, and that they really see the preferreds as the way forward in terms of financing their Bitcoin stack. Now, if we look at rosier scenarios where Bitcoin's growth rate outpaces the cost of the preferreds, or at these let's say 10% dividends, then they're going to be able to issue more and more preferreds. So today they actually have a very small leverage ratio, and they've been criticized for that. In fact, if, for example, Mr. Chanos has pointed out that they are not particularly highly leveraged, and it's fascinating because there's also other commentators who think that they're over leveraged. So I think that that's where there's definitely that lack of education. But as they come out and issue more and more perpetual preferreds, and I think the first time I've seen this is at least they pointed out that they could get to 50%, where essentially 50% of their capital stack would be preferreds, and 50% of it would be the common stock equity, which is a much higher leverage ratio than they currently have. But as they point out, if the cost of the preferreds of 10% is less than the returns on Bitcoin, that whole spread accrues to the common stock. And so that's where they're able to argue that their multiple of MNAV could actually be much greater than where it currently is. And so if we look at, okay, well, over the next 10 years, if they are growing their capital base, not just by issuing more common stock, but also by proportionately issuing far more preferreds, and that there's lots of demand for these, and that the interest that they're paying on the preferreds goes down because of that increased comfort with using Bitcoin as collateral, that they go from, let's say, a 10% to an 8% to 6%, and that the US dollar is lowering interest rates as well, right? With the Federal Reserve signaling that they could be lowering interest rates. That's where we enter into a scenario where strategy could go from having 4% of the Bitcoin out there to 8% of the Bitcoin, right? Which is an astronomical number of more than 1.2 million Bitcoin being on their balance sheet. What would that do to the Bitcoin price as well, right? Where if you have that amount of demand just from strategy, compounded by all the demand from their competitors, if we want to call them that, although really, they're cooperating in this endeavor of unlocking capital markets for Bitcoin. I think that's where we really get into the moon math, right? Of Bitcoin's value tremendously increasing from all of this corporate demand that reflect both the financial engineering, but also the just the amount of competition there is globally, whether it's here in the United States or in Japan or in Europe, from corporate buyers of Bitcoin. I also think that the credit markets are, as has been pointed out in this presentation, just way larger than Bitcoin's market cap is today. So Bitcoin's market cap today is approximately $2 trillion. The global credit markets are north of hundreds of trillions of dollars. And so if they're offering a better product to those markets, it's going to just attract a huge amount of capital into Bitcoin, intermediated through these corporate vehicles. Yeah, if we really look at it over the longer term, well, where does that leave the dollar? Because this is, I think, probably one of the more interesting challenges is the competition between dollars that are backed by other financial instruments. So, for example, if you go and hold dollars in a savings account at a bank, those dollars are backed by, let's say, mortgages, right? Where that bank is lending out and so ultimately it's backed by real estate. Um, but if you're holding dollars in your brokerage account in Stretch, it's backed by Bitcoin, and or it's backed by Strategy that is ultimately backed by Bitcoin. And so you're going to see more and more demand for Bitcoin as collateral, and arguably less and less demand for all of these as collateral, which is going to create a very interesting macroeconomic transformation, because it's going to be, well, so you could argue that it's going to be harder and harder to finance real estate because of all that financing going into Bitcoin and being attracted to it. And so it really is going to be pulling dollars away from real estate, from corporate borrowers, from all these private credit markets that have been driving kind of the demand for credit historically. It's going to be interesting to see, okay, do they have to adapt in how they finance themselves? And so we've seen companies, for example, like Battery Finance with Andrew Hahn saying, well, in order to prevent all of these dollars to get sucked into the Bitcoin ecosystem, you're actually going to have to integrate Bitcoin into real estate finance, and saying, okay, well, this real estate is not just real estate. It's also real estate plus 10% Bitcoin. And to be able to structure transactions like that so that they're going to be able to compete against a strategy going forward.
Yeah, I think for myself, even I've been in Bitcoin for 5 years now, and like I just still struggle to wrap my head around the level of moon math that can happen when you have the reflexivity of Bitcoin adoption driving demand for Bitcoin as collateral. And there's really this reflexive flywheel of the more Bitcoin, the higher Bitcoin goes, the more valuable it is as collateral. Therefore, the higher its value should be. And there's really just this reflexivity that, at the scale of someone like Strategy, when they're in competing to enter such large markets of these yield bearing instruments, I think it really is a bit daunting to think about where that could take them. Yeah, I think you lay out that scale very nicely, and it'll be interesting to see where that competition goes for what forms of collateral are competing against Bitcoin. I think we could think about this as kind of the great collateralization of Bitcoin right now. It felt like that was the moment yesterday where there is a business model to be built around Bitcoin as collateral. Like that's becoming very, very evident here. And so very early innings still, but will be fascinating to see just how far Saylor and Co can take that.
Yeah, I agree. And if we take that flywheel and we trace it back to its root cause, I really think it is the scarcity of Bitcoin. That, okay, there's only going to be 21 million Bitcoin ultimately. Already, most of them have been mined, right? Most of them are on the ledger. I think that we're now north of 95% of the Bitcoin have been introduced onto the ledger. And so there really is not a whole lot of dilution left from new Bitcoin being added to the ledger through the mining process. And that scarcity is enforced by a decentralized network. And so, just the ability to run your own Bitcoin node is really, I think, what is at the root of this flywheel, that then when you get to the kind of 10th degree of impact, that now you have these credit markets that are developing on top of Bitcoin. So I bring that up because I think that there's a real serious risk outside of the Bitcoin treasury companies. We're actually seeing the development of altcoin treasury companies, where they are seeing the success that Saylor has had with his approach, and they are trying to mimic it with other cryptocurrencies. And I think this is a huge risk because they actually don't have that root cause of having a decentralized network of nodes that's enforcing the absolute scarcity of a monetary policy that's already fully developed, in the sense that all of these Bitcoin are all already on the ledger. And so if you look at a lot of these other cryptocurrencies, you have single points of failure where the nodes are not that decentralized. The development process for it is not that decentralized, where it introduces the problem of, well, what if the developers start adding more units to the ledger than was kind of in that social contract at the beginning? And I think that that will be their ultimate undoing, where the flywheel falls apart because the scarcity of the underlying asset becomes very fragile as its value increases. There's this huge temptation to print more tokens as the value of the tokens increases. And so that will be a trend to watch and to caution about as well, because obviously there's lots of enthusiasm about the Bitcoin treasury model, but we always have to bring it back to first principles of, why does this engineering work? In order to have good financial engineering, it has to be built on top of great software engineering.
Yeah, absolutely. And I think what will ultimately happen is the risk will be priced in. I think that's what we're seeing today with Bitcoin in its monetization phase. Is Bitcoin's risk, or what I would argue is kind of its risk-free nature in many ways. Or I suppose in all the ways I would go as far as to say, is that's being priced in continuously. And I think we'll see the same thing for all other forms of collateral, altcoins included. Um, yeah. Oh, go ahead.
Well, yeah, you mentioned risk free. Let's point out.
Yeah.
I think a risk that was brought up on the earnings call yesterday was about the drawdown risk of Bitcoin's purchasing power, which historically has been, volatile, in the sense that I think you've got approximately three 70% to 80% drawdowns from peak to trough in Bitcoin's history, and then lots of other 20% drawdowns. And so one of the big questions for strategy historically and going forward is, well, what risk does that present to their capital structure to have this amount of drawdowns? And their CEO, Fong, pointed out that during the previous bear market, their capital structure was actually more fragile in many ways than it currently is, because they did not have the perpetual preferreds. And they had things like a margin loan from Silvergate against their Bitcoin, and that had liquidation triggers in it. Now, thankfully, they did not get triggered, but it just goes to show that for the critics who say that Bitcoin treasury companies are going to take on more and more risk until it breaks, you could argue the opposite, that because they are learning from the past and also innovating on their capital structure, they're taking on less and less risk with regards to those big drawdowns, such that they're going to be very resilient going forward. And the reflexivity of that would be that maybe we don't get those big drawdowns anymore, because what those big drawdowns are reflective of is large holders who got over leveraged in the bull market, who are having to sell and liquidate in the bear market, and really driving down the price. And so if large holders instead are very conservative in the bull market, and then see the bear market as an opportunity to dollar cost average in and to continue to buy, that really decreases the trough. And so it's a big open question of, will we see a big 70 to 80% drawdown again? Perhaps not, if the market participants are buying when we're down 25%, when we're down 30%, and they're all piling in, seeing kind of the opportunity to get in at a lower cost basis.
Yeah, I think like Bitcoin's idiosyncratic risk has dropped quite a bit. To your point, I think there just is a class of holders, the ultimate dollar cost averaging crowd in the ETF buyers. I think like these passive flows are great for supporting the price, and I really think that much of Bitcoin's risk has just become overall credit risk in the larger financial universe. But to your point, like I don't know what Bitcoiners will be exposed to that, and how much Bitcoin will they have to sell. I suppose is an open question, but I think my bias generally is that um, we'll see volatility continue to trend downwards, but we're also going to see, to your point, I think just this perhaps a just slower grind and a move away from just the hyper volatility of previous cycles. Remains to be seen. But yeah, Pierre, do you have any final thoughts on the earnings call? I think we covered some ground here from this move towards perpetual preferreds, as well as just kind of strategies, banking model, and really diving deep into Bitcoin as collateral. But is there anything else that stuck out to you during that earnings call?
Well, I'll just bring it back to where we started, which was the earnings per share and the change in the accounting methodology, because you just mentioned the passive flows, and those are actually interrelated because of the rules about getting included in the S&P 500. If they, according to kind of the letter of the rules at this point, they do qualify MSTR to be in the S&P 500. And recently we saw Coinbase get in. And so this would be kind of the second big Bitcoin related company getting into the S&P 500. Um, However, there is some discretion where the committee that chooses or ultimately approves what companies go in the S&P 500, they could decide to exclude MSTR. And so that'll be something to watch going forward. Now that they have kind of that earnings per share in the positive that gets them to qualify for the S&P 500, will the committee use their discretion to block MSTR? Their argument, I imagine, would be that MSTR's balance sheet is just Bitcoin, and they don't like that for some kind of arbitrary ideological reason. But hopefully they're objective about it and accept the fact that, hey, look, this is one of the largest companies in U.S. capital markets, and if they approve it, that will unlock massive passive inflows for MSTR, which will allow them to continue to increase their capital base, buy more Bitcoin, and ultimately, as Fong pointed out, they could potentially become the biggest treasury company in the world and surpass Berkshire Hathaway. I think Fong gave it a 3 to 5 year horizon to accomplish that. So we're rooting for them.
Yeah, wow. Boggles the mind to think about, but I think that's a great place to leave it there. I think the word of the day has been reflexivity as we think about potential paths forward for strategy and just the Bitcoin flywheel. Yeah, well, with all that said, Pierre, thank you for jumping on the show today. I appreciate your time as always.
Thank you, Spencer.